to the point of bonds, really from about 1982 to very recently, we're in a secular bull market for bonds. Rates kept on going down and down until you really got to a zero bound with the Fed funds rate. I mean, you can go below zero. It doesn't seem to be very successful workout to most folks. But zero really kind of seems to be a pretty logical place for that bond bull market to have ended. And then we have, had a spike in rates since then. They're definitely ticking up. There's a lot of reason to think that that trend could continue. It not at the pace it's going by any means, but enough so that we could be moving into a secular bear market for bonds, a long-term period where instead of the prices of bonds going up as rates come down, we're in the opposite paradigm, where the prices of bonds get set lower as rates go up. Now, that doesn't mean they can't serve a really useful part in your strategy, because they still have that kind of protection in a typical recession. They're still producing yield and income. You hold them to maturity, you still get the income. They can still play a role, but what it does mean is there's a very good chance that kind of kicker to performance of always being able to kind of count on gains as the prices kept going up and the rates kept going down, that's probably gone, and they're not going to be long term from a return perspective as advantageous as they've been in the 80s and the 90s and so forth.
Yeah, so the zero bound is a whole conversation for another video. But essentially, are you going to pay somebody to hold your money for you? And so that's the implication of a negative interest rate, and that's why the zero bound has so many problems with it, because it really is a catalyst to creating things like crypto and those sorts of things. Because if people aren't going to pay you a return for your money, then you're going to just stick it under your mattress or in a Folgers can. As far as the interest rate, yes, I mean, since 1982, really 30-40 years, the interest rate has gone straight down slowly. And this strategy, the 60/40 portfolio, has certainly benefited from that. Now, when it reversed that trend, given we hit the zero bound, I would say that the results are not in, but it would appear that it is at least turned, and that initial bounce from zero up to where we are now, around 4%, is a pretty stark bounce. So, but the good thing is that if we reset the baseline and we're now able to earn that income or that coupon from our bond portfolio, then this strategy should regain some prominence.